Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stock market macro updates, June 18th. This video presents a direct informational narration of the source document. Well, let's dive right in. Traders woke up today to find that the anxiety brought on by yesterday's Federal Reserve meeting has basically been fully absorbed. So here's our agenda for today's briefing. First, macro and geopolitics. Second, platform tools and promotions. Third, options expiry and market mechanics. Fourth, the semiconductor and hardware surge. Fifth, software and defense divergence. And finally, number 6, our market outlook. We're going to move chronologically through all of this provided market data and platform features. Starting off with Section 1, Macro and Geopolitics, getting our contextual baseline. Okay, so we had a massive geopolitical development. The source details that Trump and the Iranian president signed a memorandum of understanding to end the Middle East war, right at the Palace of Versailles in Paris. As a direct consequence of this, the Strait of Hormuz reopened and Iranian oil exports resumed. Almost immediately, we saw oil prices and U.S. Treasury yields take a fall in response. Naturally, this agreement brought some huge relief for inflation concerns. And it really dialed down the market anxiety about continuous interest rate hikes from the Fed. Leveraging this positive news, the U.S. stock market kicked off a solid rebound. The Nasdaq posted an impressive gain of 1.91%, and the S&P 500 went up 1.08%. Now, the Dow Jones kind of dragged its feet a bit, weighed down by cyclical and industrial stocks, closing with just a 0.14% gain. The VIX, the volatility index, it dropped. So ultimately, the market smoothly passed multiple major tests, including the SpaceX IPO, the Washington inaugural meetings, and this brand new U.S.-Iran peace agreement. But uncertainty definitely still exists. Following the FOMC meeting, the big question on everyone's mind is, will the Federal Reserve actually continue to cut rates? Will the stock market keep up its upward momentum? And will tech and AI stocks keep riding on those interest rate expectations? To figure this out, the market is going to depend heavily on upcoming data trends. It's absolutely crucial to track indicators like whether inflation continues to fall or if employment weakens. Key data releases, we're talking GDP, PCE, CPI, and non-farm payrolls, they are the exact things that will determine if market expectations for rate cuts actually shift. Moving on to Section 2, Platform Tools and Promotions, specifically looking at Moomoo integration. When you're trying to track all these complex macro shifts, tools like the Moomoo platform become highly relevant. It gives you an economic calendar that shows the exact release times for core economic data. So things like CPI, PCE, non-farm payrolls, FOMC meetings, and Washington speeches. You can set up subscription alerts so you're totally prepared before important data drops. And that's vital, right? Because markets often trade on expectations beforehand and then repriced afterward. The platform also has these great visual charts for tracking macro trends in inflation, employment, and interest rate expectations. Plus, it features a free premium newsfeed covering hot topics like AI and semiconductors, complete with push notifications. These feeds are sourced directly from Reuters, The Wall Street Journal, and Bloomberg, which honestly saves you some hefty subscription fees. All of this lets you review the calendar, analyze the trends, and combine news with individual stock movements for some really systemized market tracking. The platform is also running some notable promotions right now via their exclusive link. For Canadian users, depositing $1,000 gives you a draw for 10 free stocks, and an $8,000 deposit bumps that up to a draw for 30 free stocks, and that includes chances to grab shares in companies like SpaceX and NVIDIA. Meanwhile, U.S. users can receive up to $1,000 in NVIDIA stock rewards, while also earning up to 8.1% annualized interest on their idle cash. On top of that, Moomoo and Nasdaq are jointly hosting the Canadian Top Trader Real-Time Trading Competition. The stakes here are serious. We're talking a total prize pool exceeding 1 million CAD, with a maximum individual reward over 100,000 CAD. The top 50% in yield get rewards, and even just participating gets you in on lottery draws and task rewards. Just keep in mind, registration is open until June 30th, and the competition wraps up on July 31st. Let's transition to Section 3, Options Expiry and Market Mechanics. Today, we are looking at a staggering $8.3 trillion in U.S. options exposure, concentrated and expiring. That literally shatters historical records. To put it in perspective, this volume is 18% higher than the previous record we saw back in December. Because of this massive expiry, large capital institutions are heavily adjusting their positions. Short sellers are technically covering, while long positions are stepping in to take profits.
Because of all this activity, the S&P 500 index closed with what's called a doji star pattern. If you're unfamiliar, it's a technical signal that shows a tense tug-of-war between short-term macroeconomic pressure and long-term structural support. Over the past 2 weeks, dojis with extended upper and lower shadows have appeared consecutively. Technically speaking, this tells us that the period of unilateral upward movement has temporarily paused and market divergence has popped up at elevated levels. Essentially, institutions are turning over their positions at these highs and initiating a systemic washout of weaker hands. But there's good news. This week, the index successfully closed above the 5-week moving average. That indicates a healthy, strong consolidation moving sideways with absolutely zero signs of breaking down.
Adding to this structural picture, Citadel Securities data shows that the funding ratio of the top 100 pension funds in the U.S. just hit 110%. That marks the highest level we've seen since 2001. Scott Rubner, who is the head of strategy at Citadel Securities, highlights that we're entering one of the most critical technical position adjustment windows of the entire year. Over the next 2 weeks, expect the market to be driven by mechanical sell-offs and capital washing, with fundamentals temporarily taking a backseat. Here's the reasoning. As the quarter ends, those U.S. pension funds are highly profitable from massive prior gains. To lock in those profits, some funds will mechanically reduce their risk exposure before month-end. It's actually expected that the market will face tens of billions of dollars in mechanical selling of stocks to buy bonds right up until the end of the month. But Rubner emphasizes that these downward fluctuations in the coming days are purely technical adjustments and should be viewed as buying opportunities. Why is that? Because around July 1st, a massive new wave of structural capital, like retirement account contributions, target date funds, and passive investment products, will enter the market. Look at Citadel's statistics. Over the past 11 years, the S&P 500 has gone up every single July, and the Nasdaq 100, it's recorded gains in 17 of the past 18 Julys. Retail investors remain a massive driving force here, and historically, July is the second highest month for retail participation.
Now for Section 4, Semiconductor and Hardware Surge.
Looking at specific sectors, Intel's share price surged an impressive 10.64%. This was sparked when Trump posted that the U.S. government had previously assisted Intel, obtained a 10% stake, and that the stake is now highly profitable. He also mentioned that Apple has agreed to give its chip orders to Intel to design and manufacture domestically. Now, even though Apple and the White House haven't confirmed this, the market reaction was undeniably robust. Historically, Intel Foundry Services has sustained massive losses because they lacked external top-tier customers. But if these rumors hold true and giants like Apple, Nvidia, and Musk's Terafab project move in, Intel could structurally reverse its fundamentals and essentially become the U.S. equivalent of TSMC. Driven by this incredible momentum, the Philadelphia Semiconductor Index, or the SOX, jumped 6.4% today, hitting a brand new historical high. This sector just keeps attracting capital, and it's supported by 3 main things: Middle East peace, increasing high-risk asset purchases, Asia-Pacific semiconductors rising concurrently, and AI computing demand continuing to explode. Plus, the rebound effect of leveraged ETFs really amplified these gains. Year-to-date, the SOX has rocketed nearly 90%, totally leaving the S&P 500 in the dust. Memory chips also saw gains across the board. Adding some fuel to the fire, investment firm Alethea Capital released a report significantly raising price expectations for DRAM and high-bandwidth memory. Their report indicates that memory, which includes DRAM and HBM, is actually surpassing traditional logic computing to become the most critical bottleneck and synergistic component in AI hardware. Get this, by 2027, its value proportion in the AI hardware system is projected to soar from the current 40% to over 70%. The main takeaway? Memory is no longer just a component. It is becoming the absolute core of AI infrastructure. Because of this shift, capital is aggressively pouring into hardware infrastructure, led by Marvell Technology and major memory manufacturers.
Section 5, Software and Defense Divergence.
Now, contrasting with that hardware surge, the software sector's performance diverged pretty sharply. Accenture reported Q3 revenue of $18.7 billion, which was slightly below expectations. And despite announcing a huge $4.1 billion acquisition of 3 cybersecurity companies to build an AI plus security mode, the stock actually plummeted 18%. That brings its year-to-date decline down to 51.6%. Similarly, ServiceNow hit strong technical resistance after a 65% rebound, encountering heavy profit-taking and giving up most of those gains. Since entering June, the software sector has seen a massive withdrawal of capital. High interest rates are simply crushing the appeal of software-as-a-service valuation multiples, especially when you compare it to the concrete, rigid capital expenditure that is actively supporting the semiconductor hardware space. Meanwhile, SpaceX stock, SPCX, continued to pull back. Post-IPO, the company is planning to issue at least $20 billion in debt to refinance a bridge loan that matures in September 2027. This pullback comes after a rapid surge that pushed its market cap close to $3 trillion, which honestly drained a lot of liquidity from the broader market. So its current pullback is releasing profit-taking capital, and that's actually facilitating upward movement in other sectors like semiconductors. Over in the utility sector, stocks went up as the U.S. Department of Energy promised to accelerate data center grid connection approvals. However, utility stocks like VST hit resistance after consecutive rebounds, which prompted short-term bullish capital to just take their profits. With rate cuts looking less and less probable right now, utility stocks are mostly relegated to swing trading. In the defense sector, the leading stocks collectively plummeted, and it's because of a strict new clause from the Senate Armed Services Committee. This new rule says that without Department of Defense approval, defense contractors are strictly prohibited from conducting stock buybacks or issuing dividends. This effectively destroys the stable cash flow and high dividend logic that normally fuels defense stock bull markets. As a result, yield-seeking capital is accelerating its way out. If you look at Northrop Grumman, or NOC, its stock price is expected to probe downward, with the next support projected around the $490 to $500 level, and even that might not be the definitive bottom. Let's wrap up with Section 6, Market Outlook. So, what does this all mean? In summary, acute geopolitical risks have stabilized, corporate earnings are strong, and the macroeconomic direction is still positive. However, because of the highly concentrated options exposure that's expiring, mixed with that pension fund rebalancing at month end, the index is likely to experience some short-term chop. This structural setup makes a unilateral short squeeze surge pretty unlikely. Instead, we should anticipate intense sector seesaws, just like how we saw capital exiting SpaceX to catalyze the upward movement in Intel and memory semiconductors. The approach indicated from the source material is to capitalize on dips in AI hardware that is supported by strong capital expenditure. But as this historic July market cycle approaches, the real question is, will you be caught in the mechanical sell-off, or are you positioned for the rebound? Let us know what you think in the comments below.